Hey everyone, three stocks at or near their 52-week low. As you know, I've said this before, stocks falling is a great place to start to look for value. But just because a stock has fallen a lot does not mean it's a good value. Let's take a look at the first stock. Number one, CHWY. Guys, the all-time high for CHWY is $120 per share back in February of 2021. It is currently at $15.95. That's a fall of almost 90%. Might get exciting to go look at it, but proceed with caution. I will say this about CHWY. Phenomenal customer service. I would much rather buy from CHWY than Amazon when it comes to dog stuff. My wife and I always prefer to buy from CHWY. They are phenomenal. They care about the customer. You can talk to somebody very easily at CHWY. I cannot rave enough about this company. Let's go look at the fundamentals of the business first. So first off, market cap of $7 billion. Now, look at this net income here, $40 million right here. But let's look at, after somebody stops messaging me, their free cash flow was almost 10 times higher last year. They're showing free cash flow of $343 million. In the last 5 years, their free cash flow has been $95 million, while their net income is negative $66. This is a good thing when the free cash flow is higher than net income. That's why I put these here in our software, so you have easy access to look at it. So on this kind of company, I want you to focus on that free cash flow number. And from a price to free cash flow, it's currently selling at 20 times free cash flow. The 5-year free cash flow is 75. Don't even look at this. This company is so young. They're growing so fast. Let's go look at their income statement. Their income statement right here. Look at this. I'm going to go to annual. Let's go look at their revenue growth. Back in 2018, they did 2.1 billion, then 3.5, 4.9, 7.1, 8.9, 10.1, 11.15. They've grown a ton. But guys, in the last year, it's barely 10% growth. Still excellent. They've got a good gross margin of 28%, which is higher than Amazon, higher than Walmart, higher than Target. So we like seeing that. Profit, they have finally become a profitable business in the last 2 years from a net income standpoint. But as I told you, their free cash flow is greater. So we're going to the cash flow statement, and they do have adequate free cash flow here, and they've had it for the last 4 years. They've had free cash flow over the last 4 years and growing. So nice job, CHWY. So let's look at the 8 pillars here before we go on to analysts. Now, guys, this debt level right here is one of our pillars that shows an X. The 5-year free cash flow, you remember, is way lower than the last year free cash flow. I don't even care about this. This is a check, in my opinion. This, I'm just immediately making it. Let me change the color to green, and let's go with a green check mark there. I don't consider this an X, okay? Shares outstanding, not a huge fan of this, but that's okay. They've only increased their shares by 12%, even though their stock hit 120 a share, which was hardly justifiable. So guys, I've always said about the 8 pillars, it's a way to tell a story. And this story is telling me, combined with the company's history, this is a startup. This is a very young company. Yeah, $11 billion in revenue, we're calling it a startup. It's a young company that's becoming profitable. I'm not worried about this as much. It doesn't tell the full story. So let's see what analysts are saying about this company, about what their estimations are. All right, so 39 cents a share in profit this year, 19 cents a share next year, 88 cents a share the year after, and that's not very good. But again, it's EPS, earnings per share, not the cash flow. And let's look at the revenue. Wow, revenue growth they have going out much further, 11.3 to 18.9 billion. So guys, the benefit of younger companies is a lot of growth potential. The downside of younger companies is a lot more volatility, a lot more likely they don't last, et cetera. And in fact, the third company I'm going to show you of these 3 companies we're talking about, it's a very young company that is about to go under. So that's why I want to talk about that. Guys, interesting thing. 4 major super investors own shares in CHWY. Ken Griffin, Steve Cohen, Paul Tudor Jones, and Joel Greenblatt. So I'm not telling you to mimic those guys, but it's a good way to sit there and say, oh, these smart investors own this company. I wonder why. Doesn't mean you should own it. I don't know when they bought it. You can find that information out there, but I don't know why they bought it, okay? Now remember, you're going to buy a company based on fundamentals. You're going to keep a company because of the emotions, and that's how you're going to make the most money. In this situation, I want you guys to see, this is the chart of the company. Now, you might sit there and say, whenever we see a company fall and we don't own it, we're like, yeah, this is awesome. When you own it along the way, it sucks. Now, I will say that at $120 a share, this is a $60 billion company, $60 or $70 billion company that generated on the high side, not even that year, $300 million. It was way overvalued. I'm sure you can find our videos back in the day. And if there is one, let's splice it in right here. Guys, this is a video I made December of 2020, right before the peak for CHWY. And this is what I said as my recap for CHWY. CHWY is trying to be its own company that just sells specifically their own products, not like Amazon, which has third-party sellers. I'm not saying no, but at $44 billion, you have to have a really, really good story and a really, really direct line to profit to be interested in this company at this price. I think this is in a void right now. So what's the right price to pay for CHWY? Let's go to our stock analyzer tool. Guys, when you see a stock, actually go back, that wasn't it. We wanted to go talk about the emotion. So if this company was really worth a good price here and you owned it and watched it fall, being able to stick with the fundamentals is the emotional side of investing. Peter Lynch says, I bought companies at 12 bucks that fell to 2 and then went to 50. Okay, so the good news is that quote we just had, it wasn't worth that. It's on my watch list for much lower price. So I avoided the company, avoided the hype by saying, hey, it's not making sense to me. So that's why when it falls, I can be much more aware. Now, if this company does make sense to me and I like it and the fundamentals keep getting better and I owned it, but the stock fell, that's the emotional side we need to work on. So let's go see what this company really is worth to us. I'm going to go to the stock analyzer tool. I'm going to find CHWY in my history. The last time I did it was December 27th of 2023. All right, so here are my assumptions. Guys, I did a 10-year analysis, okay? Revenue growth. I did 3, 6, and 9%. Now, last year they did 10%. I'm going to assume it's a little bit slower because it's a younger company. I want to be a little more cautious. I put 3, 6, and 9%. Could I see 4, 7, and 10? You know what? Good point. I just talked myself into it. I'm going to do that. Now for profit margin. Okay. As they grow, they have no profit since they've existed. Free cash flow is around 3% last year. So I sit there and said 4, 7, and 10% profit margin and free cash flow. Is that accurate? That's the hard part about these small companies. We have no idea. I have no idea what they're going to make in profit. But I look at it going for a company with 28% gross margin. Okay, that seems reasonable. 4, 7, and 10% seems like a reasonable spectrum. Okay, fine by me. Now, PE. And price to free cash flow. Guys, I'm a little apprehensive about this one. I'm putting 15, 18, and 21, and my bias for loving the company and their customer service is showing here. And I'm hoping they can take that and really build on that. They're a company that should be able to grow and probably be, my guess is, they might be an acquisition target for somebody someday. But for the time being, paying 15, 18, 20 times earnings for a company that's growing and has a great customer service experience and people love. Every dog owner I know, and I mentioned CHWY, they always go, oh, I love that company. Every single one of them does it. And if you're a dog owner who loves it, let me know. You hate it, let me know. Now, I did put a desired return in here. Since it's a young company, I want big returns here. I put 15, 20, and 25%. That's my margin of safety. And remember, we need margin of safety because we don't know the future. Investing valuation is an imprecise art, and we're human. We make mistakes. And the more risky the investment, the bigger my margin of safety needs to be. So instead of doing 9% for the market return, I did 15, 20, and 25. So my numbers are going to be a lot lower than maybe yours are if you know the company. Hit the analyze button. Well, guys, actually look at this. I have a low price of 11, high price of 27, middle price of 19.50, which is significantly higher than today's price. So if my middle assumptions all occur and I bought today, I can make 23% of my money. That's interesting. So I actually think this is a company to take a look at. I'm actually going to increase my watch list price to 15. I'm actually going to talk to Dalton and say, hey, Dalton, let's look into CHWY a little bit. Now, this is not a company I want to have a big position on. It actually goes a little bit against what I'm trying to do for my entire portfolio, but if I put a small amount in maybe a tax-deferred account, it might make sense. Now, like I said, you use the fundamentals to make a buying decision. But the emotional side of being okay watching a stock fall, that is the hard part, and that's what really makes a lot of money. Every great investor, including the 4 that I mentioned before that own CHWY, have always said, sitting on your hands and doing nothing is what's going to make you the most money in time. Worrying about the everyday stuff, that's the hard part. And every single one of those guys, you have, I have, we've all made emotional decisions with money. And I can guarantee it's called cost all of them a lot of money. That is an absolute certainty in life. But you're here to learn about the fundamentals. What I encourage you to do is to realize that you have to learn about the fundamentals and couple it with the emotions. That's how you invest with confidence, putting those together. Back in 2020, when this company was on its way up to 120, it was hard to sit there and hear people say, you don't get CHWY, Paul. You don't get it. You don't get it. I didn't get it because I look at every investment as the present value of all future cash flow. And at that point, that did not make sense to me. I think at that point, the company probably wasn't even generating more than $10 or $20 million a year in cash flow, but was selling for $70 billion. But the flip side happens when you buy a great company that is increasing its cash flow and you see the stock start going down. Your emotions tense up. Wait, I thought this company was a great company. Why is the stock going down? Remember, Mr. Market determines he's in a good mood some days, he's in a bad mood other days. The hard part for you is being able to pull away from the emotion and say, hey, what's really happening with this company? The fundamentals are the same or getting better, and the stock price is going down. That's the hard part about emotions. That is the hard part about investing. And that's exactly why I spent millions of dollars creating this software and the community to be able to make the right decisions based on fundamentals and to be able to back that up with the emotions from the community, the support from the community. I use these tools every day for those exact reasons. I make my data-driven fundamental decisions, and then I go to the community to get the input from people, to see what they're saying, and to help back up what I'm saying and also put in the holes in my comments. I was sick of making emotional purchase decisions. Oh, that company's cool. That stock's going up. I've done that. I was done with it. I wanted to make the right fundamental decisions and then focus on the emotions afterwards. And you can have that too. That's why the community is here. So guys, I'm not asking you to make a permanent lifelong decision. I'm asking you to make a short-term decision by getting in the software. Click the link below, $7 for 7 days. That's all you need to do. And I assure you, you'll walk away feeling better about money and having a better understanding of how to handle the emotions and the fundamentals together. Stock number 2, Walgreens. Guys, Walgreens, I used to own Walgreens. I got rid of it for one main reason. This is a big company, and they did a terrible job. Their return on invested capital was awful. The return they get on the money that's in the business is terrible. And I sat there and said, I'm out. I don't want to have anything to do with it. Another reason I didn't like it was this. Look at this market cap, 18.8 billion and enterprise value of 88 billion. That difference of 70 billion is debt. Their 5-year average free cash flow is 2.75 billion. That is way too much debt for me. Now, I love Walgreens. I prefer Walgreens to CVS from a store perspective. When I go international, I see Boots over in England. I love it. Great place to shop at to get what I need. But again, we're separating the company from the price. Now, there are some major investors who own Walgreens. Steve Cohen, Jeremy Grantham, Ken Griffin, Joel Greenblatt. Sounds a lot like CHWY, doesn't it? So it makes me wonder what is going on there, right? But they have them, all right? Let's go check out some other metrics. Look at the 8 pillars. Actually, 4 X's and 4 check marks. Low PE, low price to free cash flow, right? Revenue growth, net income's down. Cash flow is actually down more than net income. That's kind of concerning. I think I was wrong completely on Walgreens, and I got out of it, luckily, way before the real bloodbath occurred. But this company is coming off its major lows. Right now, it's about 10% higher than its all-time, than its 52-week low. So maybe there's some value there. The question is, are you okay with the debt? That, to me, is the big question. And you're going to look at this and go, Paul, look at this dividend yield, 8.8%. It's attractive. But again, their dividends pay out $1.7 billion. Their 5-year average free cash flow is $2.75 billion. That's a huge chunk. And last year, they had negative cash flow. Negative cash flow last year. For me, I was just like, listen, I'm out. There's too many negatives going on here. I think it takes a little bit more than a hope and a prayer for this thing to work out. So I moved on from that. Stock number 3. Guys, I want you guys to all look at this one because NEO is quite the company. Quite the company. All-time high, January 11th, 2021 at $66.99. Yesterday, it hit a 52-week low of $4.45, and today it's at $4.50. Guys, this is quite the fall from grace. Quite the fall from grace. I still remember. Here's another video of what I said about NEO back in early 2021. This is terrible. This is X. Look, they have look at their operating cash flow. It gets worse and worse every year. So this is getting worse and worse every single year. X, and there's no price to free cash flow. X because it's negative. Okay, let's talk about this, Uncle Seth.
Okay, so
how long did that take us? About a minute?
Usually this takes us 15 to 20 minutes.
Let's talk about
the hype.
Guys, this is a hype stock. This is all about euphoria. It's about people saying, look how much money I'm making. It's Seth saying, I'm making about 52%, about 56% of my money.
Yes.
Guys, do you see this thing? This is called parabolic.
Now, other channels that I watch, Paul, that we won't even say their names, they love this parabolic climb because this absolutely means they even guarantee it's going to just keep going, Paul.
Oh.
Absolutely.
So let me ask you a question. Can anybody find me a parabolic rise in history that just kept going? That didn't end up doing this?
Well,
you can't.
Can I enjoy the ride up, Paul, and then
sure.
just sell when it starts falling?
And you're right. We don't know when this parabolic rise will stop. But don't call it investing. You're not investing. You're purely speculating, hoping the parabolic rise just keeps going. But here's what happens.
Go ahead, Paul. This is the killer.
Are you selling? Exactly. You're not selling. Everybody thinks they're going to leave faster than everybody else. This could have been the first drop. Oh, but it went back up. This could have been another start of the drop. Nope, it went back up. This could have been a start. Nope, went back up. This could have been, nope, because this is what happens. Everybody thinks that all these drops are going to be on the way up.
Well, it's down 4 or 5% down today. So.
And then when this starts to go like this, it'll go like this, and then like this, and then like this. And everybody's going to say, no, this is a start, this is a start, this is a start. Okay, just keep going. Now, guys, no surprise here. No super investors own this stock. They're talking about going private. The company is just in shambles right now, profit-wise. The revenue, but the funny thing is, look at this revenue growth. A low side, 200 million, 1.16, 1.72, 4.55, 6, 7.55. Guys, running a publicly traded company, look at these losses. Minus 500 million, minus a billion, minus a billion 7, minus a billion, minus a billion 3, minus a billion 5, minus 3 billion. Guys, when a company has this many losses, this much in losses, there are only two ways to pay for that. Take on debt or dilute the F everybody and sell equity. Let's go see how much equity is being sold here. Their shares outstanding is up 68% in the last 5 years. So for those of you who owned it 5 years ago, you've been absolutely diluted here. Absolutely diluted. You have so many more partners on. What this means is, if the company had 10 shares outstanding and you owned one, you own 10% of the business. Now, they increased the number of shares by 68%. So it went from 10 shares to 16.8 shares. You still own one share. Now you own less than now you own a little bit over 5% of the business, about 6% of the business. That's it. From 10% to 6%, that's dilution. You stuck in with them. You sat there and said, I'm going to be with you. And they reward you by making you less of an owner. I can't stand it when companies do that. But guys, the reality is when companies have losses, they have to fund those losses somehow. It's either ladle the company with debt or dilute the owners. Those are the only two ways to do it. So guys, there's talks of NEO going private. That may very well happen. For me, it's just not the investment for me. I get worried about what's going to happen in the future, the debt, things like that. So again, guys, if you want to get a hold of your fundamentals and your emotions together, our software community do both. Click the link below. And if you want to see the 30 companies I'm really looking forward to owning, watch this next video.